All right, today we're talking about the biggest, most high-stakes decisions a company can possibly make. We're talking about the billion-dollar bets that can literally shape its future for years, even decades to come.
I mean, really think about that for a second. How does some giant corporation actually decide to pull the trigger on building a brand new factory or launching a crazy new product? It's not a gut feeling, and they definitely don't just flip a coin. No, there's a real science to it. Because when the price tag is in the hundreds of millions or even billions of dollars, one wrong move isn't just a learning experience. It can be absolutely catastrophic. That's why they have a rulebook, a very specific playbook for making the right call. So let's open it up and see what's inside.
First things first, let's just appreciate the sheer scale of what we're talking about here. These aren't everyday choices. These are company-defining moves. In the world of finance, these huge long-term investments are called capital projects. And the key thing to remember is that these are not easily reversed. Once you start building that factory, you're committed. As our source material points out, these decisions really do decide the entire future of the company. So, if one bad move can sink the whole ship, how do you make sure you make the right one? Well, you need a process. You need a system. And that brings us to the heart of this whole thing. And that system is called capital budgeting. I know, it sounds a little dry, but trust me, this is where the magic happens. It's the framework that pushes gut feelings and emotion aside and focuses on cold, hard logic instead. This whole process really breaks down into 4 main steps. First, you need ideas, right? Then you have to analyze those ideas, and that's the number crunching part we're going to focus on. After that, you plan the budget and pick the winners. And finally, and this is a step a lot of people forget, you have to look back later and ask, hey, did that thing actually work out the way we thought it would? So, how do managers analyze these massive proposals? Well, think of it like they have a specialized toolbox. And inside that toolbox are a few very specific tools, each one designed to answer a crucial question about whether a project is a good idea or a terrible one. The first tool, and honestly the king of the toolbox, is net present value, or NPV for short. It all comes down to one powerful question. When you account for the fact that $1 today is way more valuable than $1 10 years from now, will this project actually create more value than it costs? And the logic here is just rock solid. It's a straight line. If a project has a positive NPV, it means you are increasing the wealth of the company and its owners. It is that simple. So the rule for using this tool couldn't be easier. If the NPV number is positive, that's a green light. Go for it. You're creating value. But if that number is negative, that's a hard stop, red light. You walk away, because the project would literally be burning money. Okay, on to tool number 2. This one is a fan favorite, because, everyone understands percentages. It's called the internal rate of return, or IRR. It's designed to answer one simple question. What's my expected annual rate of return on this investment? And the rule here is just as intuitive. See, every company has a minimum return they're willing to accept. Think of it as a bar they need to clear. It's often called a hurdle rate. If your project's IRR is higher than that hurdle, it's a go. And now for the last tool in the box, and this one is by far the simplest. It's the payback period. This tool doesn't care about complex math or long-term profits. It asks one and only one question. How fast do I get my money back? So check out this example. You invest 10 grand. After year 1, you've gotten 2,500 back. After year 3, you've clawed back 8 grand total, so you're still in the hole by 2,000. But sometime during year 4, you get another 3,000, and boom, you've officially paid back your initial investment. Seems simple, right? Well, that simplicity is actually a trap. Yeah, this tool should come with a giant warning label because it has 2 massive, fatal flaws. First, it pretends $1 in 3 years is worth the same as $1 today, which we know isn't true. And second, and this is the really crazy part, it completely ignores all the money a project makes after the payback date. It could be a goldmine for decades, but this tool wouldn't see it. So this is where things get really interesting. What happens when your toolbox gives you conflicting advice? When one tool is screaming yes, but another one is saying, hold on a minute. Picture this. You have 2 projects, but you can only afford to do one of them. Project A offers a fantastic 35% rate of return. Project B offers a lower 25% return. But, and here's the twist, Project B is a much bigger investment, so in terms of actual dollars, it makes the company way more money. So, which one do you pick? And here you have the classic showdown. Project A has the higher IRR, that's the percentage return, but Project B has the higher NPV, that's the total wealth it creates. This kind of conflict happens all the time in the real world. And here is the bottom line, the one thing you have to remember. When the tools disagree, NPV wins, every single time. Why? Because the goal of a company isn't just to get a high percentage return. The goal is to create the most wealth. And NPV is the only metric that directly measures that. It is the gold standard.
Okay, so let's zoom out for a second. We've been deep inside the company's decision-making process. But how does all this affect people on the outside, like you, the investor?
Well, there's a really clear three-step chain reaction. 1. A company consistently picks projects with a positive NPV. 2. Because of that, the value of the entire company goes up. And 3. Eventually, the stock market recognizes that new value, and the stock price rises to reflect it. It's a direct link. To make this really tangible for you, check out this example from our source material. A company with 200 million shares takes on one project with an NPV of $250 million. That one decision, all else being equal, just added $1.25 of value to every single share. That's the real-world impact we're talking about. So I'll leave you with this. The next time you see a news headline about a company investing billions in some new venture, you're going to be way ahead of the curve. While everyone else is asking the simple question, how fast will they get their money back, you'll know to ask the much smarter question, the real billion-dollar question. Yeah, but what's its NPV?